Technology here. Ready to go? We good? Okay. We want to welcome everyone here. We know we'll have a few more that come in, but we just wanted to welcome you here this morning to this tax fun, joyful webinar that we're going to have today. My name's Brad Allen. I'm one of the co-founders of Davies Allen, and just want to welcome you here as we're going to address some important things. We've had significant changes in the tax code, the most since the 80s. So well over 30 years, we've had some very, very significant changes. And so we want to make sure you're aware of what those are and that you can be up to speed on those. And then we'll also be here for some Q&A and some things like that at the end or maybe during. So I want to introduce to you some of my partners who are going to actually present to us today. They're there in the back, but Will Bryan will be one of our presenters. Bryn Siemens, Neil Mechanic, and Dustin Barnhurst. These are very, very talented accountants who love to study tax code like JW and I do. And so they will do their very best to put it at a level that we can understand and hit some of the highlights of things that we go on today. So grateful again that you're here and hope that this is helpful for you and that this is a good experience. We're going to first cover individual tax changes. Many individual tax changes occurred, and we'll do that here in this first session. So I'm going to turn it over to Will for that. He's well studied in this, and take it away, my friend.
Thank you. Well, welcome. As Brad said, focusing mostly on individual tax changes. Couple things to know. As far as the individual tax changes go, most of these changes right now are only temporary. Okay, that if Congress does nothing between now and 2025, all right, then these will all, most of what we're talking about today will go away and we'll go back to the old tax law. Well, most of the changes are also indexed for inflation. So we had an issue with some things in the past that weren't, but that's kind of a new thing that Congress did in these tax law changes. We will not, as Brad said, be able to cover everything in specific detail. We're hoping to cover the highlights that will affect most of you so that you kind of know about them. But if you do have questions or if you have questions during the presentation, we'll try to answer them as we go. But if it's specific and unique to you, we may not be able to get into it here, but we could invite you in for some tax planning at Davies Allen, and we can go into those details. So the first thing that we wanted to talk about, obviously with all the new tax law changes, there's some changes to the withholding tables. What the withholding tables are is if you're a W-2 employee, then a portion of your paycheck gets withheld to pay your federal taxes, right? And when you tell your employer how many exemptions you have, they go to a table, and that table tells them how much gets withheld out of your check. And those tables were adjusted for the new tax laws. And the hope was that the adjustment that they made would be accurate based on the change to the tax laws so that the amount withheld would cover the tax that you owe. But recently the IRS has come out and said that there's a good possibility that for some taxpayers, there will be under withholding, meaning not enough has been withheld. So this applies to you if you are predominantly earning your income through a W-2 wage, and you're hoping that the withholding coming out of that is sorry about that, is going to cover your tax. And if that's your situation, you can go online and answer some questions on an IRS website that will kind of give you an idea if what's been withheld will get you there, or we're happy to come in, or have you come in and do that. On the W-4s. Yeah, there should. To my knowledge, the W-4s are still the same. They're still the same, so that form's still the same. But the way that the exemptions you calculate the withholding from the tax tables is the tax tables is what's changed. So yeah, it may not be able to trust that. We're happy to do a calculation if you need it. So the next big change is just tax brackets. This is going to affect everybody simply because the tax rates have been lowered. If you look, this top one's married filing joint. So this is the old tax rates right here, and these are the new ones. So you can see across the board. They've been widened. If you kind of look here, you know, comparatively, you know, say you made 150,000 last year, you'd be in the 28% tax bracket. In the new year, you'd still be in the 22. And so that will be something that will benefit everybody across the board. So capital gains tax, kind of the next main one. Oh, yeah. Yeah. Uh-huh.
Let's say you fall into that category associated if you
so the question is there a penalty associated with under withholding? There is a possibility of that if you end up owing more than $1,000, and you significantly and you've under withheld. There's a possibility of a underpayment penalty that is calculated. So if you don't want it, that penalty is not significant, but if you don't want to pay it, it would be a good idea to come in and figure out where you're at, and then you can make an additional estimated tax payment before January 15th to try to avoid that. Right. When they got it, they became available, for the beginning of the year. Yeah, that's what the IRS is saying. So, and I'm sure they'll update it as they find out what's inaccurate. So, yeah.
On the point, Will, if you paid as much or more tax than you had owed in the previous year, that you still fall under that pre-penalty if you're over $1,000.
So if you pay more than if you take what you paid last year and you pay 110% of that, then you can avoid the penalty. Or if you paid more than 90% of what you owe in the current year, then you also can avoid that penalty. So it's a case by case basis. So you have to calculate specific to that. So moving on to the long-term capital gains, there basically was no changes to the rates for long-term capital gains. They're the same. Married filing jointly up to $77,000 capital gains, you don't pay any tax. You pay 15% between 77 and 479,000. Over 479,000, you end up in the 20% tax bracket. So no changes there. Treated the same. So Moving on, the next one, we'll talk a little bit about estate tax. So this would be the tax your estate would pay when you're giving inheritance to your heirs, right? In 2017 and prior, there was a exemption amount of around $500,000. So you could give your heirs $500,000 and not have to pay tax on that through the estate. Under the new tax law in 2018, that amount was basically doubled and then adjusted for inflation. Ends up being at about 11.2 for 2018, 11.2 million per person, right? For 2018, and this is another one I believe that will be indexed for inflation. So virtually all estates, most of us probably don't have that much to pass on. So this is a great benefit for those who do have significant estate. Even though this exemption is in place, that doesn't mean there's not other, succession planning that needs to be done. So still need to consider that, but it is good news for those who have a significant amount they want to pass to their heirs. So. Yes, I believe so, yes. Per taxpayer, right? As it's per taxpayer. Yes, to their heirs. Okay, so moving on. So the standard deduction, for those of you who don't know what the standard, go ahead. So the question, yeah, so that applies.
If you have a question for you, kind of bring my phone line to you, and then you're going to be able to you'll just talk into the phone, and that way anyone at home can questions.
Okay.
As well as
sorry.
So yeah. Just wait for you to go a little slow.
Okay. Thank you. All right. So basically, the standard deduction, I guess we talked about itemized deductions a little bit. So when we're calculating your taxes, if you have itemized deductions, things like state taxes paid, charitable deductions, certain medical expenses, your home mortgage interest, all those things are itemized deductions. If you don't have those, then you would qualify for what's called the standard deduction. Under the old law, the standard deduction for 2018 is listed up here. For married filing joint, it would have been $13,000. Under the new tax law, it's been doubled. Basically, for every type of taxpayer, the standard deduction has been doubled. So this is a good news for a lot of people who didn't have those itemized deductions. Now that it's doubled, a lot of people that may have been itemizing in the past will not be, right? Because it'll push them over and above what they had in itemized deductions prior. And this one is one of those that could go back in 2025. It will be indexed for inflation, so it changes every year. So we have to stay up on what that amount is. One other tax planning idea that we have for a lot of clients on this one is if your itemized deductions are falling at or near these limits, you may benefit. One example. If you
over 24,000 multiplied times your marginal tax rate, essentially the amount that you would be saving in tax.
So yeah, yep, that would be the calculation. So, and then I mean, yeah, basically that would be it. Any other question? Okay. So the next big change, this one seems bad, but they've kind of done some other things to kind of make up for it. So in the past, we had what's called a dependency and personal exemption. These were about 4,000 per person. This would be you, a spouse, your children. You would have in prior tax law, you got a $5,000 or $4,000 deduction for each dependent. Those have gone completely away. There's no longer dependency exemptions. This is also one of those temporary changes. So it seems bad, but be calm, because they've made some other changes that kind of make up for that. The one that they've made is a change to the child tax credit. And the change to the child tax credit will typically offset most people benefit. Benefit to those who have dependents under the age of 17. Those who have dependents over the age of 17, they may not. They may have a tax increase. So just kind of on the other side of that, just go over the changes on the child tax credit. Prior to the 2018 change, if you didn't owe any tax, you still get the $1,000. Under the new tax law, $1,400 is refundable. So if you don't know how much you get $1,400. If you do owe tax, then you get the $4,000 credit offset. So the other big change, correct. That's kind of the other big change, this people that we taxes for it, is the next bullet point there that talks about the phase out. Basically, under the 2017 law, when your income went over 110,000, we started looking to that $1,000 that you could get. Amount you wouldn't get any credit at all. We'll phase out of that credit. Under the new tax law, the limit where the phase out starts is a lot higher. It starts at 400,000, which means a lot of people are going to be seeing a child tax credit that they haven't seen in the past, right? Because of that phase out, and because you phase out so quickly once you hit the 110. But now it's at 400. So basically, more higher income taxpayers will be eligible, and we're excited to see that. That's one in tax planning that I've seen a lot of people benefit from. So moving on. So we talked a little bit about the standard deduction. Now we want to talk about some of the changes that happened for the itemized deductions. So if you're not going to use the standard deduction, these would be the things you would use to get up over this 20, the standard deduction limit. So the first one is medical deductions. In 2017 tax law, medical deductions became deductible on Schedule A once they were more than 10% of your income. So it's kind of a high bar to cross, but if you have significant medical expenses, this is a good deduction. Under the 2018 law, they lowered that bar down to 7.5. It's only for 1 year though. So there's a tax planning opportunity here, but it's all about the timing. The key would be is if you know you have medical expenses to pay and you can control the timing, this year would be a good year to take them. So it's very unique, but there's an opportunity there if you know if you know that you're in that situation. The next big change, this is one a lot of people are going to feel for the negative. Another itemized deduction is state taxes. This includes your real estate taxes and income taxes paid to the state. Prior to 2017, prior, all your state taxes were deductible on Schedule A, basically. Under the new tax law, they're limited to $10,000. So that's a big one.
Presentation slides be available on the website.
Yeah, this whole presentation with the explanation will be posted to YouTube. So, yeah. So those that have been paying significant amount of state tax, you're going to lose the deduction. If not, then no effect. So the next one is the mortgage interest. So basically, there's been some changes on what mortgage interest can be. Basic mortgage interest that is related specifically either to the original purchase of your home or to improvements on the home. If you're taking out a home equity loan and consolidating debt, say it's credit card, the interest no longer related to the residence. The other big change is for higher income taxpayers. Prior in 2017 and prior, if your loan on your house principal balance, then a portion of your mortgage interest would not be deductible. And under the 2018 law, they actually lowered that limit back to $750,000. And now, if your home loan principal balance is under the 750 limit, then portions of your mortgage interest could be limited. If you were at over $1 million last year, you're grandfathered in, and you can stay at the $1 million limit. You could lose that if you refi. If you're in a position where you're considering refining your house and the principal balance is over $1 million, and then you want to make sure you do the refinance, you don't increase the principal balance, basically. So if that situation, come talk to us. There's some definite planning there we can do to help to make sure you don't lose the grandfather of that mortgage interest. It could be a big one. Be total. Oh, okay. So he's asking, is it total? I believe it's total. Yeah, you take into account all of it. So, one question we get is if I take out the loan and put it into my business, deductible. And the question would be, let us know. We would need to make side. You can't make it deductible, but you got to do it correctly and make sure that the deduction happens inside the business. Yeah. Some of this is temporary, you know, as it says, some of them are temporary. It could change, but for now, that's the law. So with that, I've completed my section. I'm going to turn the time over to the mechanic to finish the itemized or the individual changes.
Will, Will said, my name is Alan. Oh,
better? Okay. I don't know what it does. It doesn't do anything for me, but I guess it works. Okay, so I'm going to talk. I'm not going to talk about anything. Okay, so I'm going to continue our individual discussion, and I'm going to start with charitable deductions, the changes from the new tax law. Mainly, this is not something that would probably affect most people. You know, you make $100,000 of adjusted gross income. That means you can, under the old law, you could deduct up to 50%. So you could deduct $50,000 of charitable. I don't know. I'm sure that you guys are all very nice people and are giving lots of money, but I don't know who's giving 50,000. So whatever you give, you're under the 50% threshold. So no big deal. The law they changed, they bumped it up to 60%. So in the new scenario, you could give 60,000 without it being limited, but that is the maximum, 60%. So if for some reason, again, I'll assume most of you you have your own businesses and maybe you have a bad year and adjusted gross income for yourself for the year is only $10,000, but you still gave 20,000 in charity, you would only be able to deduct $6,000 under this scenario of 60% limitation. You don't lose the rest, you just get carried forward to the future year. When you have a better year and your adjusted gross income is high enough, you get the current year's deduction plus any prior amounts that didn't get used in the prior year. So that's the change there. One thing I know, I'm sure you're all big college sports fans, and there's a problem here that they took away the deduction for paying for rights to seating at the stadiums, whether it's BYU or the U. You can no longer get a deduction for purchasing rights to the seats before you even get the chance to buy the season tickets. So that's something they've taken out. I don't know why, but they just, some of these things are totally random. So yeah, how does this affect me? You may lose deductibility of some of your charitable contributions. There is something I do want to mention as part of our tax planning. There's, I don't know if anybody's heard of this, there is something called a donor advised fund, which we recommend that you know, if you have the means, that you invest in. What it is a way to give more money. Let's say you don't know what you'd like to give in charity, and you want to get a larger deduction, especially with the taxes not being fully deductible anymore. And like Will was mentioning, you want to bunch your charitable deductions. You can create what's called a donor advised fund. You can give more than you know what you want to do with right away. You get, because you're giving it to this donor advised fund and you can't get it back, that amount is deductible. And then later you can inform the donor advised fund what you'd like to do with it. and you can keep it in the fund. You don't have, there's no time limits, restrictions that you have to get rid of it. But it does count as a higher tax deduction, especially if you're going to bunch your deductions. You can't bunch taxes because your property taxes have to be assessed in a particular year. You can't just pay 5 years ahead of time. They don't allow that. That was the whole big thing with the IRS earlier this year. So one item you can do to help give you a higher itemized deduction in 1 year is to give 2 years worth of charity. And this donor advised fund is a way to do that without having to know what you want to do with the actual donation. So that's just something I wanted to mention. I think I've said enough about charitable. Oh, yes.
Can you bunch state taxes when you pay your state taxes?
As far as
If like 2018 state taxes in the 2018 year or before April 15th?
from your pay, you mean? From your W-2? Or estimates, you mean?
Yeah.
Well, yeah, you can't. State income. Well, if it's an estimated payment, you can't bunch it because it's going to count towards that year that you pay it. So, because you're a cash basis taxpayer, if you make an estimate by December 31st, even though you want it to count towards 2019, it's still going to count towards 2018. Now, you've given extra money in 2018. If it now creates a refund, it will get forwarded to 2019 if you tell them to do that, but it won't count as a extra payment towards 2018 because you're still going to hit the 10,000 limit. So you can't do state taxes whether they take more money out of your paycheck or whether you make more estimates. You can't give them extra taxes because there's that $10,000 limit in the 1 year. So there's no way to get around that. That's why charitable or medical, I mean, not that anybody wants to have medical extra, but those are two of the itemized deductions that you can use. Mortgage interest, I suppose you could, if your mortgage company would allow you to prepay ahead, you could probably do some of that. But taxes are out. You can't do it. The IRS has ruled on that. Was there another question? Yeah.
Has there been any impact on expenses related to charity, travel expenses, or whatever that's?
If you have to expend, if there are expenditures in pursuit of a charitable donation, yeah, that's allowed. There are volunteer expenses. There are other expenses you can take. If it's in pursuit of a charitable contribution, yes, you can take those as an expense and or as an itemized deduction. So that's, yes, you can. There's been no change in that. Casualty losses. Oh, I'm sorry.
On the donor fund, is it a one-time funding, or can we fund it in
No.
2018, add to it in 2019?
Yep, you can do it for as long as you want to keep the fund open. Yep, there's no limit. Fidelity does a lot of these donor advised funds. But yeah, it keeps going as long as you want it open. Okay, so any others? Okay, casualty losses, I'll just quickly mention here that this is another one of those itemized deductions that have totally been eliminated. There is no deduction if your car gets trashed and insurance doesn't cover the whole thing. You have to meet some tests, but if you were having to put out additional money to get the car fixed, you could claim that as a loss. You can't do that anymore, except for losses in federally declared disaster areas. Not a very popular deduction. Nobody wants to use this. This was used for Ponzi schemes, for the Madoff thing and any others. Since then, we've had a few. You were able to do it, but the whole section on the form is gone now, so there's no more losses, except for the federally declared disaster areas. Miscellaneous deductions. This is a big section in the fact that there's lots of items that used to go into this, but whoever remembers being able to claim any miscellaneous itemized deductions, they always get wiped out because they're subject to 2% of your AGI. And I'm sure everybody here does well and has a couple $100,000 of income, so adjusted gross income, so they don't get any deduction until you have at least $20,000 of 2%, sorry, $4,000 of deductions. So this was tax preparation fees, safe deposit, rentals, all your investment fees, all your brokerage fees. All of those have been temporarily suspended. So I don't think anybody is going to be too upset about this because most of you probably never even realized you had it. Or if we put it in, it just never met the 2% threshold so that you would get anything. And even if, you have $6,000 of deduction, you still only get $2,000. So it could have helped a little bit, but losing it, all right, what are you going to do? That's another thing they wiped out. But I won't lose any sleep over it. I never got to claim it either. Okay, this is a new item starting next year, and this is alimony. So if anyone is aware, alimony, if you pay it, you get a deduction, and if you receive it, you have to declare it as income. And that's been the way for years and years and years. And it's a great audit item for the IRS. They're always checking that the person taking the deduction, there's somebody else claiming the income. If not, you're ripe for an audit. They have eliminated both sides. There's no more deduction for paying alimony, and there is no more reporting of the income if you receive alimony. So there's a few more weeks, another month for some tax planning. If you're planning on getting divorced, that if you want the deduction, you better make sure it's filed before the end of the year. So that's something new from the new tax law. Moving expenses. This has also been eliminated. I'm sure some of us have used, or most of us have used this at one time or another, maybe. But it has been temporarily repealed, like everything else, through 2025. Does not apply to members of the armed forces. If you think about page 1 of the old 1040, there's at the bottom of the form, there's the whole section of adjustments to income. There's the moving expenses, there's the alimony deduction, there's tuition and fees deduction, all these items, the IRA deductions, all these items that would reduce income. These are the things they've eliminated, and on the new tax form, there's no bottom section anymore. So this is another item they are eliminating. It does not apply to members of the armed forces, so you can still make that deduction if you're in the armed forces and they require you to move. So the way to get around this is you build it into your compensation for the moving, then you can get the reimbursement. You don't lose the deduction because you can't take it on the tax return, but it allows you, if your employer will work with you on it, it'll allow you to get the deduction or get the money for the move, and then you'll have to pay tax on it, but at least you'll get the cash to help you move. So not a big item for most people. I don't think you guys are going anywhere anytime soon. Section 529 distributions. What this is, the 529 plan, is what all the states have for higher education costs. And what they did was set these plans up. I'm sure most of you are familiar with these. If not, what it allows you to do is put away money for your kids or grandkids, whoever, for tuition. And when the money comes out later on, when the child goes to college, it comes out tax free. The earnings and the principal, all tax free. So that, and in addition, in Utah, you get a credit too on your state tax return for contributions that you make to the 529 plan. So this was it's a no lose situation. You get to put away money, and it comes out tax free. So no problem there. You can just put away money and have it come out for college. But they made a change. Now you can use this for elementary and secondary schools. What they like to say, this was a benefit for the Christian right that lobbied for this, and they said because their kids go to private schools, they wanted to be able to pay for it with these funds, and this is what the law changed to. So you could take out up to $10,000 annually and pay for elementary or secondary school. Yes.
When you put money into 529, you have to find which child or grandchild.
Yeah, you put it in to a specific beneficiary. No, you put it into for a specific beneficiary. You also can bunch it by putting in up to 5 years worth at one time, and it'll allow you to cover 5 years. Say your grandparent wants to give 75,000, they can do 5 years worth. Put away 15,000 under the gifting rules, where you can give any one person $15,000 without having any reporting or tax requirements. So you can do that. The problem is you don't give it a chance. The problem with this, allowing it to be paid for elementary and secondary school, you don't give the money a chance to grow. You know, you're taking it out and 3, 4, maybe 5 years later, not 18 years or 19 years when the child goes to college. So I don't know how wise this is, but that's the change in this 529 plan. The Affordable Care Act, I'm sure everyone's interested in this. And what has changed, the big news is beginning in 2019, there is no more penalty for not having health insurance. I don't know how everybody feels about that, but you will not be penalized. The shared responsibility payment that we always calculate when if you're in the marketplace, or if you're not, if you don't have insurance, we calculate a penalty that can be based on a flat amount, or if you make a lot of money, it's based on a percentage of your income. And if you don't have the insurance, you get penalized. And starting January next month or January, there is no more penalty. So you will not have that added to your tax bill any longer. Okay, so that's the good news. I don't know. Nobody's saying anything. I don't know if that's good or bad. Here's something. I don't know. Why is Vanilla Ice on there? He's what? Oh, he's alternative. They did this without my knowledge. I don't know if anybody really knows what the alternative minimum tax is. It's a crazy thing created in the 60s because Congress found out that, like, couple of hundred taxpayers who paid like hundreds of millions of dollars and they were paying no tax. So they said something's wrong with this system, and they came up with what's called the alternative minimum tax. And basically, it's a shadow tax system. While we're calculating on the form, the actual 1040, what your tax is based on your taxable income, there's this secondary calculation running called the alternative minimum tax, where certain items that you are allowed for deductions on the regular tax calculation, they take them away for alternative minimum tax. Things like state taxes, miscellaneous itemized deductions. You pay a higher tax rate on the alternative minimum tax, a flat 28%, even though you may be on a lower tax rate for the regular tax calculation. So you run this shadow tax calculation, and if the regular tax is higher than the alternative minimum tax, you pay the regular tax. But if the alternative minimum tax is higher than the regular tax, you pay the extra, the difference, which is called the alternative minimum tax. And it snares pretty much almost everyone in the $200,000 to $400,000 range of taxable income every year. And it was never indexed for inflation. So as people made more money, cost of living went up. It just caught more and more people. People who this was never meant to affect were being affected by it. They finally changed it to allow inflation to be part of it. And this year, with the change in the tax law, they've basically raised the exemption amount so that it's now very, very high, and only the real high-end earners will be subject to the alternative minimum tax. So this is good news. They were trying to repeal it entirely. They didn't do that, but it's been increased, the exemption, before you'll even see it as part of your calculation on your tax. It'll be very high, hundreds, I don't even remember, maybe over $400,000, but don't quote me on that. So that's a good thing. The kitty tax. Kitty tax, if you leave or if you transfer to kids that you have under the age of 19, you transfer some of your holdings to them thinking, well, they're just little kids, they don't earn anything, they'll end up paying very low tax rates while I'm paying, the highest 39%. They came up with the kitty tax to stop you from transferring out all your assets to your kids, where you still control it, still your money, but you're paying less tax for the kids because they don't pay much in the way of tax. So the way they fixed it is, if you have minor kids under 19 and they earned more than $1,900 in unearned income, meaning interest and dividends, capital gains, then you would have to incorporate their income back into your return, and then you would calculate the tax based on your tax rate. So basically, they take the money and claw it back into your return, so that the kid pays the tax rate based on the parent. So you really gain no benefit by transferring out any assets to the kids. Made a change. The change is now that the tax is determined based on tax rates of estates and trusts. Now, the estates and trust tax rates are not any different as far as the percentages than the regular individual rates, but the rates go up very quickly. So whereas you're earning, what was it, like 600,000 or 400,000 at the top rate on an individual, 39.6, you hit 39.6% at like 15,000 on an estate or trust. So so more people this way. Your highest rate will go up to the top very quickly. So yeah, they're the numbers for the rates. It's over 1,500. You're paying 37%. So that's the change. And that's why that kid is making a face. This business now, or am I still doing net operating loss, or are we done? No?
Yeah. Keep going.
Oh, keep going. Okay. All right. So here's a biggie. I don't know if everybody's familiar with net operating losses, but if you, sure everyone here has their own business, and if for some reason you have a down year and expenses exceed income, and you have a loss, you have what's called a net operating loss. It does not appear on your business return, but it's when you get your K1 and it's brought over to your individual return, you have all your other items of income, and then you include the business loss. And if the total for the year on your individual return is negative, you have what's called a net operating loss. And the net operating loss allows you to recover that loss either by carrying it forward to the future and therefore reducing the next year's income when you have a better year, or carrying it backwards and allowing you, when you paid in the prior 2 years, you paid all this income tax because you had good years, you now can take this loss, bring it back, and actually get a refund of the tax you paid in prior years. The big news is they have eliminated the carryback. So you can no longer bring your loss from the current year backwards to recover a refund in a prior year. So the only option now is to carry forward. So, you know, the assumption is you're not going to keep losing money every year. You're going to make money in the future. So it will help offset your good year with some of the loss from the current year. The other down item for this is that it's now limited to, before you could bring 100% of the loss was utilized. Now only 80% of your current year's loss can be utilized in the future. So if you have a $100,000 loss, next year you have 100,000 of income, you'll only be allowed to use 80,000 of that loss from this year. Next year, the remaining 20,000 will have to be carried forward to the future, another future year. So you could end up with losses going ahead. Used to time out after 20 years. Now there's no time limit, of course, as long as you're alive, I guess. Right? One new thing to deal with Roth IRAs. Just so everybody knows, starting in 2019, IRA limits have gone up to $6,000. So you can now put away 6,000 instead of 5,500. That wasn't on here. That was just one of those IRS announcements for when they announced inflation adjustments. So change for 2018 and forward is you can no longer recharacterize or unwind a Roth IRA. Beforehand, you could, any IRA, when you did a regular, you want a deduction, and if you put in the money and then without knowing you had made too much money, they wouldn't allow you to deduct a regular IRA. All you could do was a non-deductible. Say, I don't want to do that. You could unwind it or recharacterize it, put it into a Roth, say. Same thing here. There are limits to how much you can put into a Roth. AGI limitation. You can only make so much money. If you make too much money in a year, you're not allowed to put into a Roth IRA. But if you've already done it before 2018, you could unwind it or recharacterize it. Now they do not allow you to recharacterize it. So you sort of need to know what your income is going to be before you start making Roth IRAs, because you can't undo it.
So what do they do with the money that you can't
That's a good question. You know, as you were saying that, I started thinking of that. What? Yeah. Once done, it cannot be undone.
My understanding is that if there was an excess contribution technically given, because if you find that out at the end of the year, if you don't qualify for it, then that can still be essentially undone or unwound. But what they're trying to do is limit where essentially taking a Roth IRA and recharacterizing that to a traditional IRA is my understanding. But
That could be.
it is fuzzy.
Yeah.
I was going to ask
We're going to have to put an update to that because I'm not sure myself. I'm sorry. Yeah, I'm going to have to. We'll post an update when we post this. Oh, look at that. We've hit the end. Time for questions. Who has a question? Well, we've already answered everybody's questions. Well, I guess we're done for the moment. It looks like it's lunchtime. We'll be back at 12:30. Thank you.
For those at home, we're just going to take a lunch break here, and then we'll be back at 12:30. Thanks for tuning in with us. Again, we'll be back at 12:30. We appreciate you tuning in. Grab some lunch. Feel free to go visit our chat and submit some questions for those that are at home if you have any, and we'll try to get to those in the second portion of the webinar once we come back. Thanks.
Can you hear me? Okay. All right, everybody. Sorry to bring you back, but hopefully that was good food. We're going to start talking about the business changes now, which are exciting. No, you guys are really excited. The first thing to know about the business changes is, unlike the individual changes, most of them are permanent. They don't expire, so unless new regulation comes in, they will continue going forward. The first major change was the corporate tax rate. So in the past, for C corporations, they had a graduated tax schedule similar to our personal, only a little bit worse. Okay, a lot bit worse. So the tax rate would significantly increase on, like, I think about $75,000 of income. It would jump all the way up to the 35%. Thank you. So now they have replaced that with a flat 21% across the board for C corporations. So we have gotten questions about, should I turn to a C corp? And it's really a case-by-case basis, because there has been so many adjustments on the pass-through side as well, which Dustin will get into a little bit later, that kind of offset the decrease here. But if you already are a C corp, you will see that change. Alternative minimum tax. So Neil awesomely described the alternative minimum tax for the individual, and the corporations also have it for C corp, and that has been repealed completely now. So depreciation has is probably the most liberal I've seen it, and pretty much you can write off about anything. So bonus depreciation is now 100%. It was 50%, but for new equipment. Now it's 100% for anything, pretty much. So you can, after 9/27 to 17, so you probably saw a little bit of this on your taxes last year if you bought any equipment towards the end. You may not have been aware, but you can just write the whole thing off.
You don't have to pass it over years, certain amount of years, you can take it all.
Yes. So the question was, we don't have to pass it over years. That's correct. So the bonus depreciation, I mean, obviously it doesn't apply to specific automobiles. And we'll kind of talk about that in a minute. And then like a piece of property, like real estate, but equipment, anything like that, you can write it off. You actually have to elect out of this now if you don't want to do it. So in the past, you probably are familiar with Section 179, which is how we used to write off everything in the past. Now, I mean, it's not quite as relevant unless you've got some tax planning strategy, things that you've got going on, but they did increase the $179 limitations. So, I mean, basically what I'm getting to is you can write it all off. It's pretty liberal right now. The last part of the depreciation was the depreciation limits for autos and trucks. So on luxury vehicles, they used to cap it in the first year. You could take, it was like $3,000 max. Now they've upped it to $10,000, as well as you can do a bonus of $8,000. So you can write off $18,000 of a luxury vehicle. In the past, you could only write off $3,000, and then it was like $5,000 and then $3,000 again, and then $1,000 or $2,000 going forward. But now it's a lot. You can write it off a lot quicker now. So that's basically it. All I have for depreciation.
For trucks, though, over 6,000.
Yeah, so that didn't change on the gross vehicle weight situation, but you could bonus it instead of the 179. I did, but we're going to go back to it. Dustin's going to go over that one. He's not going to go over that one. I am. No, I'm just kidding. So did anyone have any other depreciation questions? Right to the point. That's all I had. We're going to turn the time over to Dustin. He's going to talk about some other exciting business changes.
Okay, so meals and entertainment. This was kind of a big issue for most of the year till we got some clarification on it. But when the law first came out, they basically took away a lot of what was considered meals with the entertainment. And so what they've done is they've said, no longer going to let you deduct entertainment expense. So what's entertainment expense? So that's like your golf, your jazz tickets, movie tickets, things of that nature. And before we got some clarification, that included taking clients out to a meal. That was in the entertainment section of the code that they wiped out. But we did get some clarification. They came back and they said, we'll still give you your 50% on that. And the other kind of change was if you had kind of in-office meals that were kind of employee related, they used to be 100%. Now they're 50%. So the big thing that you need to understand with this one is entertainment, can't deduct it anymore. Still a business expense, but you can't deduct it for tax purposes. Meals, all of them are 50%. So
nothing has changed really.
Nothing has changed really for a majority of meals. Yeah. So there were some that you used to be able to deduct 100% that went down to 50, but now it's just pretty simple. You're just going to have two categories. You're going to have meals and you're going to have entertainment. We're not going to deduct the entertainment piece. We'll deduct 50% of all the meals. Doesn't matter whether it's travel or just with a client out at lunch, anything like that. So that's the big thing on the meals and entertainment.
So does entertainment include like all aspects of, so for example, if you were to throw a company party and rent a venue, or I mean, what is considered entertainment in this?
That's a great question. So if you were to throw a company party, the rent venue would be, but if let's say you had like you rented like a bounce house or something like that would be more entertainment like, then that's where it becomes gray, right? So kind of the safe rule is if it's entertainment, like if it's like a movie or jazz tickets, golf, if you rented a bunch of casino stuff, right, for like a company party, that would probably fall under entertainment. But your food and that kind of stuff could still be deductible. So I guess kind of the point with that is if you're getting an invoice from someone for like the whole thing, if they could break it out into those certain areas, then it's easier for us to validate which ones are deductible and which ones aren't. All right, interest deductions. So kind of what changed is they're going to now say of your adjusted taxable income, we're only going to allow 30% of, you can only take interest deductions, 30% of that amount. So it's kind of complicated because they all kind of work in there together. But if you, and who this is going to affect is a business with a lot of debt, right? If one of your major expenses is interest, then there may be some issues where you're capped, where you're not going to be able to deduct it all. But the good news is they increased an exemption limit to where if you have less than 25 million in revenue, it doesn't apply to you. So for a majority of small businesses, it doesn't matter. And if you've got more than 25 million in revenue, then you've got a ton of expense and not a lot of income, a ton of interest expense, not a lot of income, then there may be a cap. But there's not going to be very many people that this affects. It is a new law, new rule, so we bring it up. All right. So one of the things that went away is called the domestic production activities deduction. So this used to be for specific industries that were producing things in the US. And so construction companies, manufacturers, those type of industries. If they had wages in the US and income in the US, it worked out to be roughly 9% that they were able to deduct on their taxes through the domestic production activities deduction. But that's been repealed. It's gone. But all is not lost, because what they did do is they came up with this new deduction. And this is a really big deal. And it's probably going to affect 90% of small businesses. And what it is it's called qualified business income deduction. And what they've said basically is 20% of your income, we're not going to tax you. That's pretty awesome, right? I guess pretty big deal. So it's similar to DPAD. There's some qualifications and there's some things that will affect this. And that's the basics, right? That, you know, you make 100,000, we're not going to tax you on 20. So that it's a really big deal. And there are some restrictions and some limits and some levels. So who this applies to is everybody. If your adjusted gross income is under 315,000, all of you will get it. Comes from pass-through entities, got a business, comes through. If you're under the 315 threshold, you'll get the 20% deduction. If you're over the 315 threshold in income, there's a few more things we have to look at. One of them is what industry you're in. So what they specifically say is service industries that, so it says, any trade or business involving the performance of service in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. So those are the ones that are capped at 315. So if you're over 315, you're in one of those industries, you don't get the deduction. And I think there's a phase out up to so you get a portion of it up to 415, but once you get to 415, no longer any deduction. And so apparently accountants didn't lobby hard enough because we got phased out too. But there was some clarification on that, because that last part's kind of vague when it says the principal asset is the reputation of, it's like that could kind of maybe apply to anybody, right? But what they've came out and said is it's specifically related to like licensing. So like they're using your likeness or image. So people that would affect would be as if you were a movie star or in a lot of commercials, something like that. And so the other part of this that's also a big deal and something that you need to be aware of if maybe you're the only employee in your company is if you're over the 315, it's also subject to 50% of wages. So what does that mean? Simple kind of terms, if you had 100,000 in income, your normal deduction would be 20,000, right? Or let's do $1 million, so we're over 315. 200,000, right? But if you only had 200,000 in wages, it's dropped down to 100,000. So kind of a big deal, something you need to consider. This may be an argument to increase your wage because the deduction is less than the payroll taxes. And once you get over the Social Security limit of basically 128,000, it increases a lot more in the tax savings. So if you think you're going to be in this situation where you're going to be over 315,000 of income, but maybe you don't have a lot of wages in your business, you should probably come talk to us, figure out what wage you should pay yourself to get the most effective tax deduction. So this is a really big deal, a really big change that's going to be awesome for a lot of people. You're going to save a lot of tax dollars for a lot of small businesses. So it's a pretty big deal. I mean, I don't know what more to say about it than that. Are there any specific questions about this? I'm sure there might be a couple out there.
I was just like, how does it, does that have anything to do with, you know, how you take it off?
So the question was, for a business, in an S corp, you take a dividend for part of your income, and you take a wage for part of it. Does it play into that? Towards the wage. So it would just be whatever your wage is. Other employees count as well. So total payroll in your, so it plays into there. So that if you're the only employee and your wage is lower than, you know, it's been low because in the past we've been not wanting to pay those self-employment taxes, might be time to think about raising it because you're going to get a better deduction. So, Zach, do you want to? Sorry.
They're saying, but if you're in a situation where you have, where the majority of your you have a lot of employees and a lot of payroll, then you would probably still be in a situation where you want to continue leaning towards dividends and not so much of the wage.
Yeah. So if you have a lot of other employees and you have enough payroll to cover that 50%, so where you're still getting the maximum deduction, then yeah, you'd still be fine at a lower wage and taking dividends. So as long as the wage is reasonable per the IRS, right? So yeah, this is one that is going to for a lot of small businesses. If you have any questions specific to you or your business, we'd love to have you come in and talk about it and make sure that we're getting the maximum deduction on this.
So if you are not at 315, could it still be to your advantage to increase your wage?
So,
your total earning.
So the question was, if you're not at the 315 threshold, could there's an advantage in raising your wage? Answer is no, you're good. If you're under 315, the wage rule doesn't apply to you. So no reason to increase at that point.
We got a question from our audience that's listening live. So they're just asking, if you're a business, how can we look at our withholding for the year for our employees and determine if we need to make an end of year adjustment?
Okay. If that question is about the employees' withholdings on their W-2, that's a good question. It may be too late to make an adjustment for that on the employees if we're talking about the employee's personal tax, just because it's going to be hard to know in their specific situation if they've withheld enough or not. If they're under withheld, if the question is, hey, should we give out year-end bonuses? Because we're going to be close to this 50% threshold that we need to meet to get the full deduction for the qualified business income, then yeah, then we would, the answer to that is we look at the total payroll, look at the projected income, make sure that we've got at least enough payroll to cover that. And if you get bonuses that maybe you typically give in January, move them into December, you get a bigger deduction. Your employees like it because now they've got money before Christmas, they don't have to put on the credit card, right? So that, I'm not sure if that got their question answered or not, but that's the way I answered it. All right, so this is another big deal. So the next section is on opportunity zones. So if any of you do a lot with real estate, you're probably familiar with 1031 exchanges. This is cooler than a 1031 exchange. Basically what they've came out and said is if you have a capital gain, we're going to let you defer the tax on that capital gain if you invest in an opportunity zone. What's an opportunity zone? The governors of every state, they went through and they picked these opportunity zones based on some criteria that they were given. And there's a list, there's a map, there's all kinds of information out there on where the opportunity zones are. I think there's, I want to say 25 plus in Utah. Opportunity zones, when I was looking the other day, I'm pretty sure there's an opportunity zone in every county in the state. And the cool part about this is it doesn't have to be real estate to real estate, like you have to do with the 1031 exchange. This can be, hey, I got a bunch of stock and it's appreciated in value. I don't want to pay the capital gains on it, but I want to go invest in a new business. This is a way to do it and not pay tax on that stock. Or maybe, hey, I just sold my business and I've got a big capital gain and I don't want to pay the tax on it. You can do it with this. And probably the coolest part about this is if you hold that asset that you invested in the opportunity zone for 10 years, that tax is completely forgiven. Yeah, clap. That's exciting. That's awesome, right? I guess it's a pretty big deal. So the question is, does that have to be state specific? Nope. You can do it any state in the country. Yep. Any opportunity zone in the country, you can do it.
It has to be invested in something that's in that zone.
Yep. So it has to be invested in something that's in that zone. And so what that means is you can go start a new business in there. So put all your money into a new business in there. Yep. The business would have to be located in that zone. Yep. Or maybe buy some raw land and you build an equestrian park, or you build, something. Or maybe you go in and you buy an apartment complex and you renovate it. So that is one of the caveats with it. There has to be some improvement to the asset.
What if you locate an office in one of those zones and the office is a venture investing fund that you fund with those capital?
So the question was, if the office is in one of those zones and it's a venture investing fund, should you go invest in other businesses outside of them? I think they would frown upon that. You could try it. There's yeah. So you'd probably lose. But the goal behind this law is to increase economic development in these zones, right? That's what the goal behind it is. That's what they're trying to do. Yep, geographical zones. So they're actually based on census tracts, where they'll go out and do the census every 5 years or whatever. It's based on those tracts. You had a question?
Yeah. Can individuals do this, or do you have to be a legal entity?
So the question was, can individuals do this, or do you have to be a legal entity? Individuals can do this. The way that it works is you have to set up what's called an opportunity zone fund. So what does that mean? That means you just started a new LLC and you fill out one form, send it to the IRS and say, I'm an opportunity zone fund. And then what happens is, from the time that you have the gain, so let's say we sell some stock today, you have 180 days to put that money into the opportunity zone fund. Then the opportunity zone fund has 180 days to purchase an asset. And then once the asset is purchased, they have 30 months to complete the renovations or improvements or whatever they were doing as far as that went.
So does it need to be done through anything very similar to a 1031? Actually, talking about stocks or something that you sold, proceeds, and then put it into the fund.
So the question is, does it have to be done through an intermediary similar to a 1031 exchange, or can you just hold on to the funds and then put it in there? As far as we're aware, there hasn't been anything that's came out and said you have to do it with an intermediary yet. I'm sure that's probably coming. But as of right now, nope, there's nothing out there that says you have to use a 1031 exchange intermediary. So, say that again.
Any SEC or regulations. So you're just doing an exchange of like a property that's
So with SEC rules as far as raising funds, so like if you were to go set up an opportunity fund and then people put their money into it, honestly, I don't know. So it's pretty new legislation. There's not a lot out there. I don't think the SEC has commented on it yet. So right now it's kind of the wild, wild west with opportunity zones. I'm sure a lot of those rules are coming, but right now they don't have anything just because they're so new and people haven't really done much with them yet. It's like with 1031 exchanges, there's, like kind of exchange, real estate, there's a lot of rules and a lot of things you have to do to make it qualify. So far, we don't have a lot of those rules with opportunity zones.
Can you take the property that you typically use as a exchange rather than doing a exchange? Now, you take that same property.
So the question was, can you take a property that you've 1031 exchanged into that you would typically just do 1031 exchange to keep deferring the tax and now do it into an opportunity zone? The answer is absolutely yes. You can. And that's what's so cool about this, right? Is if you've been 1031ing, you have a very low basis, but you've got a very high value asset. You roll that into an opportunity zone now, you hold on to it for 10 years, no more tax.
Depreciation recapture.
So there could be depreciation recapture, but your basis. So basically, the way that you don't have to pay tax is after 5 years, that new asset to 50%, and then it tiers up the rest of the way to 10 years to where they give you full credit for the basis. So yeah, so it's pretty big, crazy deal. Good. So our president is a fan of real estate and doesn't want to pay tax on it. It's the only explanation I've got for it. So it's a pretty big deal. If you have properties you're looking at, we can help you look at the opportunity zones, make sure it's in there, make sure that you're doing everything to qualify to get that tax deferral.
Best place to find the qualified.
So there's a couple resources, and actually the way that works best for me, if you just go to irs.gov and in the little search function, if you type in opportunity zone, there'll be a frequently asked questions that pops up. There's be a link to resources. Click on that. Take you to a link where you can go to maps and lists and all kinds of different stuff. So that's typically how I got to it. There's a few links like that that are pretty good.
There's 46 in Utah.
Yeah.
Utah opportunity zones. They're business opportunities. They're based on the census tract, and they're identified on that. This is Trump Tower in Detroit.
So, yeah. So the last two, I've thrown a lot of crazy new stuff at you, but it's all good. And so kind of dealing along the same lines. Now with like-kind exchanges, you can only do real property to real property. We used to be able to like-kind exchange a vehicle, right? Got a truck, I'm going to depreciate it for a few years. I'm going to go on like-kind exchange, not realize the gain on the trade-in, etc. The IRS came and said, can't do that anymore. Just sell the truck, take the bonus depreciation on the new one, and you end up at the same place anyway, pretty much. So personal property, you can no longer like-kind exchange. So usually vehicles were the only things that we really like-kind exchanged before anyway. Now with the new depreciation laws, it doesn't really make a difference. So no more personal property for like-kind exchanges. Accounting for businesses. This is another pretty significant change. It used to be that if you were over 10 million in revenue, you had to do accrual basis accounting. And if you had over $1 million in inventory, you had to do accrual basis accounting, and all these different stipulations that the IRS would put on the business owner based on the amount of revenue that you had. They basically said anybody over 25 million now, you can just be cash basis. You don't have to track your inventory. You can just expense it through cost of goods sold, all that stuff. So this is also pretty awesome because there's just a lot less for you as a business owner to have to worry about accounting wise. There still may be some pretty good arguments business-wise of why you would want to do accrual basis accounting so that you can match your expenses with your revenue and make sure you're making your proper margins. But for tax purposes, basically we don't care anymore. As long as you're under that 25 million in revenue threshold. So basically turns a lot of small businesses that were kind of that mid-tier back into cash basis tax filers. So, and I think the ones that it's probably going to help the most are those who were doing inventory, trying to track inventory year in, do all their inventory counts, everything. Now, if you're under 25 million in sales, basically just expense it all through cost of goods sold. Excess business losses. So there's a now on the amount of current losses from pass-through entities going to the individual. And this is kind of what Neil talked about a little bit earlier with net operating losses. So it's going to be basically you're going to get 80% of whatever your business loss is in the current year, and then it will roll forward. It's kind of the biggest thing on there. And yeah, and it's going to be carried forward, no carry back. So this one kind of ties in with the individual stuff that Neil talked about just a little bit earlier, as far as the losses from business. So it's just that 80% that you can take that Neil talked about earlier. All right, we talked about a lot of cool business stuff. Does anybody have any questions or anything you want to dive in a little deeper on? Brad, you got anything that you want to add? Fair enough.
We're currently sitting in an opportunity zone.
Yeah. Yeah, and so people think these opportunity zones aren't going to be great places to invest, but there's actually a lot of pretty good ones. Like we just mentioned, the building we're in right now, pretty sure it's an opportunity zone. So yeah, it could be, if you've got any sort of capital gains, you should figure out how to invest in an opportunity zone. So.
But this also, capital gains, I mean, could you do this? Well, if, an estate, one or both parties to die, could that work for surviving? Could you pass it through?
So the question was on an estate, so we're kind of surviving, pass it through. So if you actually have a trust and an estate plan set up, those assets are kind of in there. And those ones are kind of locked in. There may be some creative people out there that we can figure out how to get them out and do that. But right now, I don't know of any that we could kind of take them out of a trust that they're already in. But yeah. Step up in basis, depending on, and again, it depends on the type of trust. There's a lot of different things that kind of go into that question that are specific to the assets we're talking about. On whether, sorry, there's a lot that goes into that question that we need a little more information to answer. So, depends. The famous accountant answer, right? Anything anybody else back there wants to add? Mindy, you want to add anything? Okay, I think if there's no other questions, we're kind of done. We can hang around and you guys can come up and ask us individual questions, things like that if you'd like. But I think we're good for now.
So now let's kill the video and I'll have Irish revenue agent listening. This is a big deal.